Good evening, everyone, and welcome to Farmers Weekly's Partnership webinar. I'm Susie Horn, Farmers Weekly's business editor. I grew up on farms in East and North Yorkshire, where my brothers are arable and sheep farmers. Tonight, thank you very much for joining. Tonight, we're going to hear from some experts on different aspects of partnerships. And thank you to everyone for registering and joining, and to our panelists for their time and expertise. The format tonight is to have a short presentation from each of the panelists, and then we'll go into some questions that we've received in advance of the webinar, and some of the ones that you put in during the session. I'll tell you a bit later about how to do that. First of all, to introduce our panelists. First of all, we have Christopher Dolly from Carter Jonas. Christopher's a rural partner in the firm's Winchester office. He's a chartered surveyor with more than 40 years of experience advising estates, farms and rural businesses on a wide range of management issues, and that obviously includes partnership matters. Stephen Horton is a senior associate at law firm Krings. He's head of tax and trusts in their private client team, and his work for landowning businesses and farming partnerships includes drafting complex wills, trusts and partnership agreements. And then Carly Drummond is a senior tax manager at accountant MHA. She's helped many farming families with partnership formation and development with a tax efficient but very practical approach. And obviously within partnership agreements, I think you get involved in quite a lot of succession planning as well. So they're each going to speak briefly on their work, and after the presentations we'll open up things for discussion. We'll try and answer as many of the questions that we've received in advance as possible, and some of the ones that you submit during the session. If you want to see a box at the foot of your screen, that's where you can type in your questions, and do that. Try and be brief, but give us enough detail to go on, and then I'll direct the questions to the appropriate panel members. And panelists, if any of you want to jump in or I haven't included you, please either just put up your hand or just jump in. So the webinar is going to last for about an hour and 15 minutes, and anybody who's registered, they'll get an email to tell them that it's ready, that the recording is ready to view if they aren't able to view the whole thing tonight, or if they want to just go back and listen again at any time. So that's it from me for now. Christopher, if you'd like to tell us a little bit about your work with farms and their partnership matters, I'll hand over to you now, and then you let me know when you're finished, and then we'll go to Stephen. Thank you.
Susie, thank you very much. Good evening, everybody. As Susie has kindly alluded to, I've been in practice for a bit over 40 years, and for the whole of that time, I've been very heavily involved in helping people with their businesses. I sit on a number of client boards and act as managing trustee for their businesses. Partnerships are a very big part of that, and a lot of my time is spent either helping clients setting up partnerships in tandem with, of course, with accountants and solicitors. It very much tends to be a team occupation, as it were, because we all bring our own particular skills to the party. Review of partnerships is also very important, and it never ceases to amaze me what tricky situations can develop by a badly crafted partnership, or worse still, no written partnership agreement being in place. So I very much look forward to the questions this evening and discussions that Susie.
Thank you very much, Christopher. So Stephen, we'll go to you if you want to tell us a little bit about your work on the legal side with farming partnerships. Thank you.
Thank you very much, Susie. Yes, I am a senior associate and head of trusts here at Thrings, and a large part of my work is succession planning for family businesses, and particularly family farming businesses. So through that, a lot of my work is drafting partnership agreement. And occasionally I'm asked to comment on a situation where another member of the team is working on a probate matter and there is a farming interest which has some partnership to it. And very interested in what Christopher said there about how there can be some very tricky situations that come about, either in the case of no written partnership existing, a badly drafted partnership agreement, but also where there is a written partnership agreement and it's a well-written partnership agreement, but the parties to it don't necessarily fully understand what there is in it, or they think it means something else. Or what you might sometimes find is these family businesses are obviously multi-generational enterprises, and you would be surprised at what ultimately gets forgotten in the course of things. So having a think about the topic of tonight's discussion, I sort of came to a view of, well, what do I think the do's and don'ts of family farming partnerships are? And as Christopher rightly said, I think probably number one is do have a written partnership agreement. And number two is do be certain of what the assets of the partnership are, because not very often, but they can find situations whereby on the death of one of the senior generation of partners, it's actually unclear about whether something was a partnership asset or intended to be a personal asset simply used by the partnership. So do be certain of what the assets of the partnership are, I think is do number two. And as I say, my work is succession planning, so that incorporates writing of wills, and I think do number three from my perspective is do be sure that your will and the partnership agreement of your business work together, so that you know that what you think happened to your share of the business after you're no longer around will happen. If you have conflicting interests in those documents, then that can create sort of administrative problems and unwanted consequences. And again, something else that Christopher has already said, and I wholeheartedly agree with and would like to reiterate, is don't be afraid to encourage your professional advisors to speak to each other. You, as a partner in your business, will have a number of professional advisors, your solicitor, your accountant, your land agent, to name three of them. And they will have different perspectives on the work to be done. They obviously have different specialisms, but the issues that they're advising on are interlinked. So periodically reviewing what's going on as part of a roundtable discussion with those people can be invaluable. And also, if there is a particular sort of extraordinary matter like sale of a plot of development land or something like that, having those different voices involved together early on can really iron out any issues. But not just that, make sure that things are happening in the most advantageous way for you, your business, and ultimately your family. So those are a lot of things that I see in practice, and that's about me. So thank you very much.
Okay. Thank you, Stephen. So we go to Carly now, who's from MHA Accountants. Carly, over to you.
Hi there. Hi, Susie. Thank you. Hi, everyone. I'm Carly. I'm going to apologise in advance. I've got sinusitis, so I'm sorry about how I sound. If I suddenly vanish, it's because I'm sorting myself out. So apologies in advance for that. I'm going to try and carry on as best I can.
Thank you for being with us.
It's a pleasure. It's a pleasure. So I just really, again, want to reiterate what's already been said, and it's great for us as accountants who see farm businesses annually to know that we've got the support of professional lawyers that understand agriculture and land agents that understand agriculture working alongside us, because a lot of the time, people don't realise necessarily the specialism that's involved in this sector. A partnership agreement that would do any other partnership will not necessarily suit a farming business, because you've got the additional dynamics of family relationships and everything else involved in that. It's quite rare that people can come in and out of partnerships as frequently as they do in farming businesses. When they come of age, when they come back to the farm, you wouldn't necessarily see that in professional partnerships. So I think it's really important to have the backing of other professionals advising with us. In terms of what I do specifically, so I head up the agricultural tax practice at MHA, working alongside partners that head up from the accounting perspective. My general sort of view of all of this is I come at it from a very private client perspective, which means I'm looking after you. Obviously, the extension of you is the business, so I look after your business as well. And we discuss, we think about income tax planning, and we discuss things like that as well. But where it gets quite interesting, and where I sort of really like to specialise, is in the capital taxes. So where you have got one-off land sales, where you've got new BNG initiatives coming in, where you've got opportunities that are going to change the course of your business, and we need to get the tax right. But more than that, we need to get the structure right as well. And that's where I really enjoy getting involved with a lot of partnerships. I think because of the nature of my working in the agri sector, we do tend to have more partnership businesses than we do corporate businesses. Which sort of comes alongside it, and that's usually very common, and there's nothing wrong with that. It gives us a lot of flexibility. Sometimes where you've got very profitable partnerships, we want to introduce companies as well. So I think alongside all these discussions, you need to be thinking about your bigger structure. Can we use a different function for something else? Do we need to have a separate business for non-farming children so they can potentially inherit that when we're looking at succession planning and things as well? So although this is obviously a partnership session and we're talking about farming, I think when we like to approach this at MHA, we like to take a much bigger, wider approach and step back and say, this is what you have now. Where are you going to be in 10 years? Where are you going to be in 20 years? And this is where having these professionals alongside us that understand the implications of that too really help. Our annual accounts are a sign of what we think is going on in the business, and that needs to dovetail in with partnership agreements. It needs to make sure that that all marries up. Your wills need to dovetail with your partnership agreements. There's no point having people working in isolation. We all need to be talking to each other. So I think I'm here really just to promote, partnerships are great. They're usually the best thing for people in farming activities. They might need to work alongside other structures, and having an eye on the future is always really important, and having good professionals to advise you is important as well.
Great, thank you very much, Carly. Let you have the rest now.
Thank you.
We go to the first of one of our questions, which was going to go to Christopher on first. This person inherited the family farm together with their brother. They are working out away from the farm, and grass left all the land. But unfortunately, the other brother doesn't do anything on the farm or contribute in any way whatsoever. He lives in the main house, and the person asking the question pays the bills. They now need to deal with this in order to move on with the future of the farm. What can I do? I mean, they don't make it clear whether they are actually in partnership together, the two brothers, but I think for the purposes of this session, I think we probably have to assume that they are, but one's working off the farm's let, and does that work with a grass-let farm partnership where essentially neither is working on the farm?
Thank you, Susie. These kind of problems are not as uncommon as you'd like them to be. Of course, the primary thing is always to foster communication between whether they are joint landowners not in partnership or in partnership together. Communication is the place to start. In terms of what happens if that communication breaks down, if there's a partnership agreement in place, of course it may well have provisions, and you would hope it would have provisions to resolve difficulties, which may include ultimately some form of arbitration or use of an independent expert. But I think all commentators here tonight would say that any form of litigation is a last resort, and trying to get people around the table to map out a way forward must be the place to start, and only resort to heavier duty resolution processes if that has been explored and failed. That would be my view.
Thank you. Going back to Stephen's do's and don'ts, one of the add to the do's is include dispute resolution process in the agreement.
Indeed, I agree entirely.
Right, thank you. So for Stephen, this is a parent asking about sons coming home to be part of the business. They're 22 and 21. They'll be self-employed. Should the parents add them to the partnership to avoid self-employment rule queries? I'm not really sure what those are, but I'm sure Carly might be able to help us out on that. If so, how do we limit their liability, for example, for debt? Stephen, we'll go to you first, and then if there's any sort of issues on those self-employment rule queries, perhaps come to Carly on that. Thank you.
Thanks, Lucy. So it's not clear from the question that's asked what exactly the situation will be here, whether the sons will have an interest in part of the land capital that the family own, which they will farm independently on their own account. That is perhaps what might be meant by they'll be self-employed. If it's not that, but they are actually coming into the family business, then it is important to have some clarity around what their employment status is. And the reasons for that are because Carly can talk more on the tax side, but there is a difference in treatment for certain things like expenses where someone is employed versus someone who is self-employed. And from an employment law perspective, if you are an employee, after 2 years, you will obtain certain rights against your employer. So that is why it will be important to understand exactly what's happening there. But if they're coming into the family business and they are coming into the partnership, then partners are inherently regarded as self-employed persons. So that they will be self-employed if they're coming into the partnership. And then the second sort of part of the question related to, well, how do we limit their liability, for example, for debt? So again, a couple of ways to look at that. If they're joining the business, then the agreement that is put in place to bring them in should make clear what their obligations in relation to anything that's happened to them prior to joining the business. But in terms of limiting their liability, a partnership is for a general partnership, as we understand it, in terms of normal family farming businesses, is transparent for liability purposes. So that bringing them into the partnership isn't something which limits their liability. There are other structures that Carly has talked about which can limit their liability, for example, a limited liability partnership or a corporate structure. And there is obviously scope for some hybrid structure, which Carly's already talked about, and as part of the overall view of the planning that gets done in relation to into succession, that's a consideration for that. So clarity over what their role exactly will is the first thing that you need to understand, I think, in that situation.
Thank you. But essentially, if you're in a straightforward farming partnership, each partner is liable for whatever the debts are of the partnership.
That's right, and that is a function of the sort of general partnership setup.
Yeah. Okay, thank you, Stephen. Carly, did you want to add to that at all?
I think from my perspective, I took that query to be in respect of whether they were going to get caught by employment rules. If you're self-employed and you are working for one person or one business, I should say, it's quite possible that you would get caught and have to pay PAYE and things like that. So I think in that instance, that would be quite easy to see through, should it be looked at. I think the logic for me would be to bring them in as partners if they were going to be contributing to the partnership, would be to have an agreement set out to say what they're going to be doing and how we're going to work out what they get remunerated for their input. You can't have one come back and work his socks off and the other kind of coast and expect to get the same. So all of those discussions need to be had in advance of doing anything drastic like this. You'd probably also need to think about things like where they're going to live. What happens if they have a partner, a girlfriend, a child. Those sorts of discussions that we would have down the line all need to be kind of teed up quite early on when they come into that partnership, because once they're in to an extent. And I think that absolutely, if debt is a concern and you want to limit that liability, then we would need to look at other structures.
Yeah. Okay, thank you very much. Right, we'll go to another one. This is an interesting one there. This family is trying to structure a partnership for the family and for the business to progress. And the person asking the question is taking over from their grandfather. How would you structure things so that when the grandfather is no longer around, the business can still run and various aunts and uncles can be treated and paid out fairly, but in a way that's affordable for the questioner without them having to sell up? It's not clear whether the various aunts and uncles mentioned are in the partnership. But again, I think we have to make some assumptions about perhaps family ownership, joint family ownership of the land that they're talking about, whether there's a partnership or not with the aunts and uncles. Right, Carly, can we go to you first on that one?
Yeah, absolutely. So it's an interesting question, and it's one that we see quite regularly in sort of with variations here, there, and everywhere. I think quite often it will depend on what the aunts and uncles in this instance, what their motivation is. Do they want a payday? Do they want a regular income? What do they expect to do with what they own? Because we don't want to tie ourselves up. It might be one thing dealing with aunts and uncles. It might then be another thing dealing with cousins, when that goes down a generation. So we need to think about a bit of a longer term strategy here as well. If it is land ownership, often you'd be looking at paying a rent. Whether or not that is viable for your business obviously depends on that business in itself. If they're in the partnership and they're after a profit share, that can become a little bit difficult, because if they're not actually doing anything, we need to be able to justify that profit share for tax purposes, for inheritance tax purposes, and for lots of other things as well. So it is something that we probably would want a bit more detail on. If all the family are in this together and they all want the farm to continue and they've all got the same intention, it can absolutely work. And a rent would be paid, and that would kind of be the end of it. And at this level of generation, it would probably not be too much of a task. It's when it falls down another generation and you get more people involved, that's when it can kind of muddy the waters even more. So I think if everyone's pulling in the same direction, it's completely doable. If not, there might need to be thoughts about, do we want to be buying things off people? Do we want to change ownership? And how can this be sustainable long term?
Yeah. Okay, thank you very much. Stephen, that question about how would you structure things so that when he's no longer around, I guess sort of in the middle of that question is thinking about how to provide in an agreement for the retirement for illness or for the death of the partner.
Yeah. Yes, certainly that's a core element of this sort of situation. I think the first thing that I sort of want to do is reiterate what Carly said, and that is have an understanding of what people want out of this situation, and if everyone is, like she said, pulling in the same direction, then those things can be easier. And again, these conversations are easier between 2 or 3 people at the top generation than they are between sort of 6 or 15 in the second generation. So whatever that ultimately is like, you can put everyone else in the best possible situation by having within the partnership agreement rules about what the succession treatment of the partnership is. Who are my permitted successors to this in this partnership? So just to take things back a step, if there's an unwritten partnership, if there's no written partnership agreement, then on the death of a partner, that partnership will come to an end. But with a written partnership, you can deal with the situation with a partner dying. You can stipulate as part of that agreement who are the permitted recipients of that partnership interest. And as I said at the very beginning, it's important then when you have that, it's important that your will also works in hand with that. There is, to a degree, the option to sort of push things in terms of what you do in your will. There is the option to sort of push things down the road a little bit in terms of creating a trust structure to hold your share in the partnership, and that gives some breathing space to have a look at what the situation is at the death of a partner, because at that stage the trustees can look at the beneficiaries of that trust and see how they benefit them, or indeed whether it's you just wind that structure up and do something else. You also sort of mentioned in people getting old and ill. It's not tangentially related to all of that. It's worth considering the situation whereby you as an individual are no longer able to deal with your own affairs due to frailty or mental incapacity, and it's possible to put the decision-making functions in someone else's hand by way of lasting powers of attorney. And you can limit the scope of those lasting powers of attorney to relate only to your business interests. So that is another way that helps people deal with situations that arise. But what that doesn't do is take away the human element of potentially people pulling in different directions. So coming full circle, the most important thing, and we talked about it in the beginning, is to understand communication and understand what people want to get out of it, whether they want to keep hold of their land capital and receive some sort of remuneration for that, or whether they're open to being brought out in terms.
And thank you. The point that you made about in answer to this question about when the grandfather is no longer around, that also answers another one we've had, which is simply that if you have a partnership with 2 partners, what happens if one dies? Can an agreement mean you can continue to trade and won't have the bank account frozen? And short answer to that from what you said is yes, as long as the agreement provides for that to happen.
Yeah, indeed.
Christopher, I'm sure you've come across lots of family situations, that are quite complex like this. Stephen mentioned about people possibly pulling in different directions. I mean, could you add a word of caution about where there isn't a good agreement, and how long things can take to sort out, perhaps?
Yes, I think a really important thing to appreciate in this regard, regardless of what the agreement may say, is that if the business inherently isn't profitable enough to allow the objectives of both farming partners in the business and non-farming partners in the business to be realised, then there is a high probability that there will be a dispute in the making, because the question referred to being affordable but also fair to the other people involved. And in reality, if land has been ceded, for example, between 4 partners and only one is actually farming, unless the business is of a pretty substantial scale, it is unlikely that it will be able to fund the purchase out of those non-farming partners who perhaps want their capital out, or even to be able to afford to pay a market rent, because it may not have sufficient economies of scale. And therefore, you're absolutely right, Susie, the devil is in the detail of the partnership, and it may say, for example, something along the lines that capital can be withdrawn over a period of 5 years, which may give more of a chance for the continuing partner to be able to arrange finance in an appropriate way without completely damaging the business. So the terms of the partnership, in tandem here with talking about loss of the grandfather, the terms of the will, which Stephen has already referred to as being important, those two things must run in harmony, otherwise there will be opportunity for dispute.
Okay, thank you. Right. Got a question on how, this is one that's been submitted during the event. How do you bring someone into a partnership, and what are the capital gains or stamp duty implications? So I think in terms of how do you bring someone in, that's a big question, because it could be the legal side, it could be the how do you manage having a new partner. We'll assume and go to Stephen just for a brief answer on how do you bring someone into an existing partnership? What's the process in terms of the agreement and adding them? And then to Carly, please, on whether there are any capital gains or stamp duty implications.
Sure. So the process by which an individual can be admitted to a partnership is by them agreeing to be bound by the terms of that. So where you have an existing partnership agreement, a supplemental agreement or deed of addendum can be drafted to bring them in, that will confirm that the parties agree to be bound by the existing terms, or there may be some minor variation of the terms, and those will be recorded in that deed. And it will also record what remuneration in terms of income profits the new partners will receive, and whether they are introducing any capital, and what their share of capital profits will be. So it can be a relatively short document to record those facts. Alternatively, if things are changing to a degree where the family want to reach some further and different agreement, then sort of going back to the drawing board and having a new partnership agreement can be valuable, and that can be so to take account of something that I mentioned at the beginning, whereby you might have the death of a senior generation partner, and you just want to record things as they are in an up-to-date state. Record what the land capital of the partnership is, and clarify what the intentions of the partners are around their assets, whether they are partnership assets or not. So either way, it can be done by way of entirely a new partnership agreement, or a simple deed to bring those new partners in to be bound by the existing agreement.
Okay, thank you. Another question that we've had in from the session, which is, if one of go to Stephen on this one first. If one of the partners dies, can the other partners refuse to allow the person the partnership has been left to join the partnership? So I presume a partnership share has been left to someone by a partner who has died, and the other existing partners don't like the sound of it. So is there anything the existing partners can do about that?
So a partnership agreement should deal with who they're referred to as permitted transferees, who can receive the share in the partnership, and normally that encompasses family members, children and spouses and children, and can also incorporate the trustees of a will trust or of the partner. So a partnership agreement will deal with that, and it will also expressly deal with the fact of whether or not those people who take that interest in the business in fact become partners. Or it would be usual for an agreement to say that they don't become partners until they are admitted by those existing partners. So a partnership agreement will ordinarily deal exactly on the terms on which someone will come in as a partner, who that interest can be left to, and whether or not that person becomes a partner. So yeah.
Right. And I think this is probably another one that's coming during the session, probably one for Christopher, with his experience of seeing family farming situations. They're asking, how do they get around reluctance on the part of the majority partner, who's the older generation, to borrow against the business so that the business can progress through diversification? Christopher, quite a tricky one.
Yes. I mean, this is a very common situation, and again, it is it's about two things. One, what the partnership agreement says about how decisions are taken, for example, to secure land, to provide for borrowing, but also about the practical effect that the investment will have, because if a proposal is robust, if it's robust and clearly demonstrates that the investment that's being sought, if that is the situation, can provide increased profitability or improvement in the holding, and therefore the income of the partners is improved, for example, then ultimately a reluctant partner might be persuaded. But if the partnership agreement has a structure for taking decisions, then that will prevail. So I'm afraid I'm back to my point about communication, clarity, well-worked figures,
Yeah. Okay, thank you. Right, definitely one for Carly here. The question is saying that you mentioned earlier, Carly, isolating different parts of the business into different structures. So they're giving the example of a dairy farm. They've separated the milking income from the rest of the business by transferring this into a company. They're not sure how this can be done. All the cows and the milking parlour, etc., are owned by the partnership. Surely you can't simply filter the milk income via the company for tax purposes, as the company doesn't have any assets. Surely there would be tax implications for the partnership of transferring the assets to the company. Does that sound like something you've come across?
Oh no, absolutely. So I think I'd be a bit surprised if the limited company didn't have any assets. I would have thought that when this happened, it would have been a full incorporation of that enterprise. So there is something for corporation tax and capital gains tax and stamp duty purposes that all link to reliefs when you incorporate a business from a partnership into a limited company. So as long as you tick all the boxes, and there are a few boxes to tick, everything needs to go over to that new enterprise relating to the existing enterprise. So you might have a partnership that has an arable enterprise and has the milking, and you separate the milking and you move all of that over, that's fine. You need to be moving staff over, you need to be moving assets over, everything needs to go. So you'd have to think about your HR if you've got, staff, TUPE requirements, things like that as well. Your VAT, everything needs to be going over together. So I'd be quite surprised if that had happened. The only way that could happen, I suppose, is if they were doing it as a contracting arrangement, potentially. So they weren't actually doing the milking or getting the milking income into the company, but rather the company was charging the partnership to do some kind of contracting in respect of their assets, because that could also work where you've got arable farmers that contract. You're able to incorporate just the contracting element of that business into a separate company as well. When we talk about incorporation, we do we always consider the capital gains tax position, and there are reliefs for both capital gains tax and stamp duty land tax, where you've got transfer of stock, transfer of assets, transfers of land, things like that as well.
Right, thank you. Right, someone's asked a question directly to Stephen, and they're saying that assets are also included here in a trading partnership to protect the asset from inheritance tax. Where a partner owns 100% beneficial interest in partnership property, how easy is it to draft an agreement that facilitates leaving partnership property to a non-farming child who is not a partner? Well, I'd need a little time to get my head around that one, but Stephen's probably right up your street. So
the situation seems to be where you have a partner who has property which is allocated solely to their land capital account within the partnership, and how easy it is to draft an agreement that facilitates leaving partnership property to a non-farming child who is not a partner. Well, I think that this comes back to the consideration around what is the agreement about what happens to the partnership interest on the death of a partner. It's leaving partnership property, so I'm assuming that means they're talking about on their death. So where assets are partnership property, they are held on their own sort of type of trust. The partnership is a sort of trust in its own right over those assets. So they will be leaving their interest in the partnership presumably to their non-farming child. And I think this comes back to my view that it can be useful to have a discretionary trust interest over the farming the farming assets in that individual's name, so that their interest in the partnership can be dealt with by way of discretionary trust, because that allows trustees to take a view of what the circumstances are at the time of death, and how that child can be benefited and receive the benefit of that asset. And presumably in this circumstance, there is one of the other children will be farming, and I think that brings us all the way back to questions that we had before about where you have older generations passing away, and how do those subsequent generations get benefit out of that. And Chris has rightly illustrated the difficulties around doing that. But
Yeah.
dealing with that in your will, or being clear about what the intentions of the partners are following death. Is it the intention that falls away and there'll be some division of the assets, the land assets? There might be more than one farm and two sons, and I've seen those circumstances where actually they end up getting one farm each, and then the other one is free to do what they want. But dealing with that in the will, I think, is
Right.
is a useful step.
Right, we've got another one. Again, talking about people leaving the partnership. What's the most effective and fair way of balancing the interests of an ongoing farm business with a retiring partner or beneficiary who wants to withdraw their land capital? So perhaps if we go to Christopher first on this. I don't know if you've managed to work out how to do that fairly, Christopher, for some farm families, and then we'll go to Carly and then Stephen, if they both want to add something.
Yes, this is the age-old practical problem of businesses farming on the whole not generating a great return compared to the capital invested. Perfect answer to this question. Each business is structured slightly differently. Every business has different capital asset base, has different profitability, has different aspirations in terms of the partners as to how quickly they need their money out. And it is about what is the surplus being generated in able to pay out, in effect, a retiring partner. And it may be that something has to be sold ultimately to do that, or assets taken in lieu, that there is only a fixed pool of money available in any particular set of circumstances.
Okay, thank you. Carly, anything to add to that one? I think you might be on mute, Carly. Sure.
Sorry, guys.
Okay,
I'm trying to stop everyone hearing my sneezing and things. Sorry. No, I think absolutely it's whether or not it's viable, isn't it? You know, no one can work for a business long term that isn't going to pay the bills. And I think if this is going to cripple the business, then you have to be thought about long and hard whether that business has got a future or not. Quite often you will find that the person retiring is quite sympathetic to wanting the farm to continue, and may be happy to take payment over a number of years. You know, they may also have an emotional attachment to that business. They may have grown up on the farm, whatever it is. You would hope they would be sympathetic to wanting that business to continue and wouldn't want to do anything that's going to cripple it too much, with debt or whatever. So I think you need to think then about the terms of how you could get them out. And a lot of that will be dictated in the partnership agreement already. And really it's about having a sensible conversation with people. It's about saying, look, guys, I appreciate what you want, and there's a big number in this balance sheet of the accounts to what this business is worth, but really that's not pounds and pennies. You know, and fair isn't always equal as well. You know, a fair return on what you can have doesn't mean 50-50. So it's about having a sensible discussion with hopefully two parties that are minded in the same way. If someone just wants to take their money and to hell with the rest of it, then, you know, we're a bit stuck to an extent. But I think it's about trying to get people reasonable across the table and have that discussion sensibly.
Thank you. Stephen, anything to add to that?
I don't think there is much I can add on top of that. But yes, as I say, viability is the main element to it. And as Christopher said, it may be that ultimately there's a sale of land to fund it. And as Carly rightly said, fair doesn't necessarily mean equal. And if there is sort of accord between the individuals, then I agree. Sometimes there is a deal to be done because one party is sympathetic that it's been their childhood home or whatever.
Right, thank you. Another one that came in before we started the session. If one partner, and I'll go to Carly first on this one, and then Stephen. If one partner is doing all the work and has invested equal capital, is there any way of them receiving some form of salary, or must it be a profit share?
So you can receive what we call a prior share in profit. So quite often we will see that, the profit share will be split in such percentages amongst the partners, but one partner will be given a £20,000 prior share, for example, to reflect that they are more active on the farm. We'd normally see that agreed in a partnership agreement and then agreed annually as well, depending on what the profitability of that business has been for that year. So that's documented in the accounts. I think it would be quite hard to do if not all the partners were on board with that, unless it was documented somewhere. But absolutely, that's quite a common thing where you've got, certain partners more involved than others. You will quite often see these prior shares being allocated, and it is just treated the same as profit share. But it's just, before you split your bottom line in percentages, you take a chunk out and give it to one or two of the partners in priority, and then you do your percentages afterwards. So it's taxed the same way as profit share. It doesn't come via PAYE or anything along those lines, but it is just a way of acknowledging that people might have a bit more skin in the game, essentially.
Yeah, thank you. Stephen, do you echo that or add anything?
Yeah, as Carly said, that can be part of the partnership agreement. A prior share, sometimes referred to as a partnership salary, but it's not really, as Carly rightly says, it's not really a salary. It's just an allocation of profits before they get divided up. That can and is frequently agreed upon as part of the initial partnership agreement.
Thank you. Right, one for Christopher now. This person says that she has little agricultural knowledge. Her husband was the farmer, who we have to assume is no longer around. She has two sons working with her. Wants to know how she can guide them with her lack of agricultural knowledge. I think I could probably answer this one, Christopher, and it's get a competent land agent or consultant.
Yes. Yes, I couldn't agree more. It is about taking appropriate advice and enabling the sons to get appropriate training. There is such a range of training available, be it with the local ATB or local college. It may be that they go off in rotation so that there is physical manpower on the farm, but it is about getting advice and accumulating the appropriate knowledge, both in a business sense and an agronomic and livestock husbandry sense, depending upon the nature of the farm. But it's about getting up to speed to keep the business robust and fit for purpose, really.
Yeah, thank you. Right, we've got one question submitted by this person before the event started, and then two subsequently. So it makes a big question, but I'll start with the first bit and then find the subsequent ones. So they want advice on the family farm partnership agreement, the key events that might arise within that partnership. There'll be 3 members. The partnership has a tenancy on the land it's farming. And if you just bear with me, I'll find the rest of those questions. Yeah, here we are. So when one partner owns most of the land, should there be a tenancy agreement included? And should it be time limited? If so, how many years? Also, is it better to have 3 in a partnership agreement if possible? Right, we'll go to Stephen first on this one.
Presumably they're asking, is it better to have three in a partnership agreement because then someone has a casting vote.
Yeah, I think that's probably what's behind that one. Yeah.
So where you have two partners, that I think probably Christopher can speak from practical experience about what can happen in those situations. Sometimes one can be elected as a managing partner or have a casting vote in things. So I don't know. I'm sure Christopher has got some good anecdotes on that element of it. Should there be a tenancy agreement? Well, there doesn't need to be a tenancy agreement if you have a partnership which is working on land owned by one partner. They should be clear about whether that land becomes a partnership asset or not. If it does become a partnership asset, it can be credited to the land capital account of that partner to show that they are the one who has brought that land into the partnership, and on a dissolution of the partnership can be dealt with accordingly. That I think is so. The start of that question says the do's and don'ts for a farm partnership, and that is one of mine. Be sure what your land capital is. Keep those separate from general capital. So when you come into the partnership, you will bring an amount of money which will be your general capital, and you might bring in property, farmland, which is then your land capital. Some partnership agreements you will see just has one heading, capital, with a figure underneath it, and that can then be difficult later on to ascertain what went into that. You've got an amount of money and property at book cost. I don't know, Carly might have a view on this, but certainly from the perspective of later administration, I find that it is better not to have undrawn profits then in later years wrapped up into general capital, because that confuses what it is that the individual has brought into the business. So in accounting terms, those things should be reflected differently. So having a separate general capital account to a separate land capital account, and having plans within the partnership agreement to show exactly what the assets are, to eradicate any later confusion. So I don't necessarily think that a tenancy agreement needs to be in place if they're intending to sort of to operate on those terms.
Thank you. Carly, did you want to add anything to that?
I think exactly what we're doing with a lot of our accounts now, because farming balance sheets in partnerships can be immense when you've got land on balance sheet, and I don't always think that's reflective of cash flow. And you can look at that bottom figure and think, blimey, that's a big amount, and you think, well, where is it? Well, the answer is it's all in the land, and when you've got it all put in together, it just isn't reflective of the day-to-day position. So what we try to do with ours is we have a current account, which will be your profit goes in, your drawings come out, and that shows you essentially what you owe the business and what the business owes you. Then you have these land capital accounts, and that then can be ring fenced for individual partners to show the underlying sort of ownership of that as well. And it does then identify exactly what is partnership property in terms of what is within the business and what is outside of the business. And when you are looking to do things with partnerships, we've got people that are keen to leave their current account balances to one person and their land to another person, and it just helps make that much clearer. I think in terms of the partnership agreement, for us, it's absolutely crucial, because we get that clarity, and it's really important to have that work with the accounts. And also, I think similarly to when you're drawing up wills, don't think that you could do a partnership agreement now that is going to cover every eventuality for the next 30 years. It isn't. You have to revise it. And part of this question was about the key events, and part of that will be when somebody comes in, revise it. When somebody leaves, whether they pass away or they exit the partnership, revise it. If someone gets married, all this sort of stuff you need to think about. Do we want to think about prenuptial agreements alongside all of this as well, cohabitation agreements? Any big life event, a big sale of development land, that it all needs to be revised. And I think we need to get out the mindset that we do one will, we do one power of attorney, we do one partnership agreement, and it lasts us forever. It doesn't. Our lives change, and the agreements have to change to go alongside that. And in terms of the question in respect of, is it better to have 3 in a partnership? The way I read that was that is it better to have 3 in a partnership so you've got continuation should one of the partners die or exit. And I would say absolutely, if you've got son and mother in her 80s, I would always suggest there was somebody else in, just so you haven't potentially got a cliff edge where mum might pass away in advance. Because it does cause problems, although you might have continuation in bank accounts and things like that. In terms of HMRC, you can't have a partnership run with one partner. So that partnership will technically end at that point. So I would say from that angle, I would always recommend where you've got differing ages of partners to have more than 2 involved. But please don't think you can just draw up your partnership agreement once and it's going to last you forever. They're worth their weight in gold. They need to match up with the accounts, but they do need to be revised.
Thank you. Christopher, we've already covered a lot of ground on that question. Have you got anything to add on that one?
Well, I would just come back to that primary point about voting rights, and it does cause problems where there are only 2 partners and there is no provision for a sensible, flexible resolution process. And for that reason, we tend to discourage absolutely 50-50 partnerships where there are only 2 people. And this very day, I have been helping clients with renewing their partnership agreement. There is a life event going on. A son-in-law is now coming in, and we have very much got, because we'll now have 4 people in the partnership, one of the partners with the casting vote. But also today thinking very much about what if that partner were to be run over by the proverbial bus. Yes, we're back to 3, but you've got to think about what you want to happen in that scenario. So, careful thought in the drafting, please.
Thank you. Right, Stephen, you are a trust specialist, and we have a trust question. A business has been put in a discretionary trust. The trustee and POA, you'll have to educate me there, are refusing to allow the one working partner to profit from the business. What takes precedent, the original partnership deed or the discretionary trust?
POA, I was assuming, is power of attorney. I don't know.
Yes. Yeah.
Is it? That power of attorney will. A power of attorney is something which enables someone to act on another person's behalf during their lifetime, and after their death, their will kick in. And I'm assuming that this is making the assumption this is a discretionary will trust. So I'm not sure where the power of attorney part of it comes into it, if that's what that that's what that refers to. But so what was the situation? The trust, the farm is held in trust, but there is one working farmer.
One working partner, yes.
And
it says that the trustee and the power of attorney are refusing to allow the one working partner to profit from the business. That gives rise to their question about what takes precedent, the partnership deed or the discretionary trust.
Yeah, I mean, it's not clear to me on what basis they wouldn't be able to, they would be able to prevent him from profiting, presumably by demanding that there is some benefit which the beneficiary of the trust should make, i.e. pay us some rental income or something like in that order, where the rent becomes punitive in terms of what the profit of the farm is, presumably something like that. But and I think that comes back to situations that that Christopher has talked about in terms of it's possible that when these situations happen, you are ultimately in a situation whereby one person who is running the business isn't able to happily do that and create an income which they can live off because of expectations by other parties. And then the ultimate question was, what takes precedent, the partnership agreement or the trust? Well, the partnership agreement will dictate what the relationship is between the trustees of the trust, presumably, and the working partner, and that will set out what their profit shares and capital interests are and that sort of thing. The trust will set out that the trustees hold those assets for the benefit of whoever the beneficiaries of the trust are. So they have different functions, and it seems to me probably what the breakdown is, that the trustees have come into the business because of the death of a partner previously, and there is some expectation that some rent or something like that is paid for the use of the land which the trust owns. So I think probably there just needs to be some accord about what the expectations of those parties are, because ultimately the bottom line is if the working partner isn't able to continue with the business, then there will likely be a dissolution of that relationship, and potentially land sales or whatever. Now, who knows? There may be some element whereby one party is hoping that they will force that situation. I just wonder if Christopher's come across something similar in his travels.
Yes, I have. And the problem generally stems from the need of the trustees to have a return on the asset that they've got then an investment in, because invariably there are other beneficiaries that they need to have proper regard to in discharging their duties. And it would be very uncomfortable these days for a trustee to not take notice of the wishes of a beneficiary. Gone are the days where trustees sailed on, happily making decisions and not having that due regard. But today, I think it's pretty essential, and indeed the fiduciary duty on a trustee is pretty high. So that asset has got to be generally utilised in a proper fashion.
Okay, thank you. Thanks, Christopher. Definitely a tax question now. So back to Carly. It doesn't mention partnerships, but they're asking, can you gift farm cottages and do a holdover election to hold over a capital gain if you're passing to the next generation in your lifetime? So it may be in a partnership, it may not, but perhaps you can talk about.
Yeah. Okay. So that it's a really interesting little, I want to say trick, but it's not the right word, that we can do to move property without capital gain in certain circumstances where you have got farm cottages. Now, in this instance, I assume it's a cottage on the farm and not specifically a farm worker's cottage. If that is the case, Usually, we would need to move it with some land that qualifies for APR.
Mhm.
And it can piggyback then on the holdover election from that land, which would qualify for APR. So the stars do need to be aligned a little bit for this to work,
Mhm.
but absolutely that can happen. And it's a really great thing to achieve when you can, because it's impossible now to sort of transfer property without a capital gain, especially with the budget having changed the FHL rules. So I think yes is the answer, but we need to make sure everything lines up and stacks up to make sure that we can do it.
Yeah. You mentioned at the beginning of your answer that you assume it's a farm cottage and not a farm worker cottage. What would
Yeah,
be the
so
difference?
a farm worker's cottage or a retired farm worker's cottage would have APR in its own right.
Right.
So you wouldn't necessarily need to do the land with it,
Right.
because it's a holdover election that links to the APR
Yeah.
availability as opposed to the capital gains tax position. So again, we just need to check exactly what's going on. If it's a partnership asset, if it's not a partnership asset, we might find it harder to do. But again, that can be rectified if that's what we want to achieve, and we've got a bit of lead time into doing it.
Yeah. Okay. Thank you.
But please don't just go and do it. Take
No.
some advice on
Definitely.
it,
Yeah.
because we do need to have the right circumstances.
Yeah. Yeah. I think that's a general caveat that should sort of
Yeah.
accompany all of these webinars and the advice that's given in them, because every situation is different, and please don't act on the advice given tonight. But plenty of food for thought, obviously, and pointing people in the right direction. All right. Quick question, which I think Stephen will give us a very quick answer to. Are farming partnerships under Scottish law different to those under English law?
Don't know, and I'm not regulated to advise under Scottish law. We are regulated to advise only on the law of England and Wales, so I've never bothered to find out. I'm sorry.
Yeah. Okay. Not to worry. Thank you for a clear answer. All right. Okay, another tax question. Carly, sorry, we're taxing your voice as well as your tax head. Do you pay inheritance tax on investment assets already in the farming partnership? And then in brackets, if the asset passes from one partner to another within a Balfour structured partnership.
So if you've done your Balfour assessment and you are happy that you meet the tests and everything qualifies, then
Probably need to give people a couple of
yeah.
lines on the Balfour
So
test.
your Balfour test. So the Balfour test is based on a case. It's case law. It's not statute. So it's important just to understand that it's not something that's actually written in the statute book, but we use case law as a way of getting around this issue. It was a case whereby it was an estate that had farming activities, but also had rental activities and just general landed estate activities going on as well. The business in itself was deemed to qualify as a whole enterprise for business property relief, so 100% 100% AP, 100% IHT relief when the owner died, because it was wholly or mainly trading, which we take to be 50%.
Yeah.
So what we can do with partnerships, and the reason why they are great for things like this, is if you have got enough land in your partnership that is farmed in hand to frank, so the value of that land is enough to frank other assets such as rental cottages, whatever it could be, that are rented, then you can essentially piggyback on the IHT relief on the trading element of that business to get it on the investment element of that business.
Yeah.
It's a really, really good balance that you have to get. We
Yeah.
say 50-50 from case law. There's been lots of talk about that moving to 80-20. So 80% trading, 20% investment, which is the rules for capital gains tax purposes. So it'd be quite an easy thing for the government to change. But they haven't done it, obviously, to date. So if you are within that balance, and it's not just asset value that we look at as well. We look at turnover in the investment versus trade side, profitability,
I'm
time
sorry,
spent with partners.
just so that we don't so that we don't completely run out of time. We've only got 1 minute left. So
yes, it's fine. Yeah. If you fit in with Balfour, it's fine.
Yeah, thank you.
Usually.
So with 1 minute or less to go, thank you all very much for with us tonight. Thanks to our audience, and lots of advice, lots of food for thought. As I said, I'm sure it's been really useful. Thank you, and thanks for staying with us, Carly. Can't be with you. Thank you. So Carly, Christopher and Stephen, thanks very much.
Thanks.
Thank you.
Thank you.